If you're young, just starting out and trying to figure out investing, you've probably heard the same advice again and again. Start early. Be patient. Don't time the market. All of it sounds good, but no one really explains how to do this in real life when you're juggling studies, a first job, limited money, and constant distractions. Here's the truth most people won't tell you. Young investors don't fail because they lack intelligence. They fail because they lack systems. In 2025, artificial intelligence is quietly solving that problem. AI isn't about turning you into a trader or making you rich overnight. It's about building a portfolio that runs in the background, grows steadily, and doesn't depend on motivation or perfect timing. This video is for Gen Z beginners who want to invest smartly without stress, confusion, or a finance degree. We're going to break down how AI helps you build a portfolio that grows itself, from tools and asset allocation to risk control and long-term discipline. Time is the most powerful asset in investing, and young investors have more of it than anyone else. Even small amounts invested consistently can outperform large investments made later in life. The problem is that most young people either don't start or don't stay consistent. Emotions, distractions, and short-term thinking ruin long-term growth. This is where AI changes the game. AI doesn't get bored. It doesn't forget to invest. It doesn't panic during market drops. It quietly does what humans struggle to do: stay consistent. For Gen Z, AI isn't a shortcut. It's a discipline engine. Let's be clear. No portfolio grows without risk or effort. When we say grows itself, we mean automation, structure, and rules that reduce your need to constantly make decisions. An AI-supported portfolio automatically invests money, rebalances assets, adjusts risk over time, and keeps emotions out of the process. You still decide the direction, how aggressive you want to be, what your goals are, but AI handles execution. Think of it like autopilot. You're still the pilot. AI just keeps the plane stable. Asset allocation is the foundation of investing, and it matters more than picking individual stocks. Most beginners get this wrong because they either go all in on hype or stay too conservative out of fear. AI-powered platforms analyze your age, income, goals, and risk tolerance to suggest a balanced mix of assets like stocks, ETFs, bonds, and sometimes alternative investments. For young investors, AI usually leans toward growth, but with diversification built in to reduce unnecessary risk. This removes the guesswork. Instead of copying YouTubers or guessing percentages, you start with a structure designed for your stage of life. Consistency beats intelligence in investing. The biggest reason young investors underperform is irregular investing. Some months they invest, some months they don't. AI fixes this by automating contributions. Money is invested on a schedule, regardless of market conditions or mood. When markets are high, you buy less. When markets are low, you buy more, automatically. This strategy quietly builds wealth while you focus on life. You don't need motivation. You don't need perfect timing. You just need the system running. Risk is unavoidable in investing, but unmanaged risk is dangerous. Young investors often think risk means all stocks or crypto only. That's not strategy, that's gambling. AI tools continuously monitor volatility, correlations, and drawdowns. When risk becomes excessive, portfolios are adjusted. When conditions stabilize, growth exposure increases again. This doesn't mean avoiding losses, it means avoiding blowups. The goal isn't zero volatility. The goal is survivability and compounding. Fear and greed destroy more portfolios than bad investments ever will. Selling during crashes and buying during hype cycles are classic mistakes, especially for beginners. AI doesn't react to headlines or social media noise. It follows rules. Rebalancing happens when it's needed, not when emotions demand it. This keeps your long-term plan intact even when markets get ugly. Over time, this emotional protection becomes one of the biggest advantages AI provides. As you grow older, your financial situation changes. Income increases, goals evolve, risk tolerance shifts. AI tracks these changes and adjusts your portfolio accordingly. Rebalancing ensures that no single asset dominates your portfolio for too long. It locks in gains and reallocates capital where it's needed. Manually doing this is tedious. Most people don't. AI does it quietly and consistently. This is how portfolios stay healthy for decades, not months. The adaptive decision-making layer then contextualizes these insights against broader market conditions, adjusting position sizes and timing based on factors like liquidity, correlation with other assets, and macroeconomic indicators. This creates a dynamic investment approach that can constantly evolve as market conditions change, something neither traditional human analysis nor rule-based algorithms can fully replicate. This kind of multifaceted analysis exemplifies how AI can bridge the gap between human intuition and computational power, offering a third approach to investment analysis that complements both traditional human and algorithmic methods. AI is making its mark as a powerful tool in modern investing, offering capabilities that can enhance investment decision-making and portfolio management. While many of these tools remain only available to sophisticated institutional investors, they are increasingly becoming available to retail investors. However, it's crucial to remember that AI is not infallible and should be used as part of a comprehensive investment strategy that includes proper due diligence and risk management, in conjunction with human oversight and decision-making. Many young investors either expect AI to make them rich quickly or don't trust it at all. Both approaches miss the point. AI isn't magic, it's a system. Another mistake is overchecking. Watching your portfolio daily increases anxiety and leads to unnecessary changes. AI works best when given time and trust. The smartest move is boring consistency, and AI excels at boring. Success doesn't mean beating the market every year. It means building habits, staying invested, and letting compounding do its work. Over 10, 20, or 30 years, this approach quietly outperforms most active investors. You won't feel rich overnight. You'll wake up one day realizing the system worked. Gen Z doesn't need more motivation, it needs better systems. AI allows young investors to start early, stay consistent, manage risk, and grow wealth without stress. Not by being smarter, but by being more disciplined. AI doesn't replace your decisions, it protects them. And for young investors, that protection is priceless. If you're Gen Z and serious about building wealth the smart way, like this video. It helps more beginners find clear, no confusion investing content. Subscribe for practical AI investing strategies made for real people, not Wall Street pros. Comment below. What's stopping you from investing right now? Money, fear, or confusion? And share this video with a friend who thinks investing is too complicated or not for people our age. Your future portfolio won't grow because of luck. It'll grow because you built the right system early.